This is Duke University.
All right, we'll get started. Good afternoon, everybody. Everybody doing okay? Good. It's a beautiful day. This is our truly committed group here with as beautiful weather as we have outside to be inside in a mostly windowless classroom for the next 3 hours. I think it'll be worth your while. I'm really excited about this. I'm Dan Vermeer. I'm the Executive Director for the Center for Energy Development and the Global Environment. I know many of you, but not all of you. The center is focused on helping to accelerate the transition to a more sustainable and prosperous energy system, economy, and society. And clearly, entrepreneurship and innovation is key for making that acceleration happen. So I'm really excited about the seminar that we pulled together today because what we want to do is be able to, first of all, understand what's the broader landscape. Energy is not an area I think historically people have thought about being a really obvious place for entrepreneurship. Maybe innovation, but maybe not as well. There's I think a system that's been built over the last 100 years that has incredible capabilities, but I also sense that sort of reaching the limits of its capabilities, a real need to move to the next step in terms of what the energy system of the future will look like. The role of entrepreneurs, typically the energy space is an area that is capital intensive, highly regulated. There's a lot of barriers to the kind of free innovation and entrepreneurship that happens in other parts of the economy. But nevertheless, I think the time is right to look at those opportunities in this space. What are the technological opportunities? What are the market opportunities? Both in the developed world context and increasingly in the developing world context, where 1 out of 4 people in the world have never touched an on switch of any sort. And so I think we can expect over the course of all of your careers for this to be an area of really radical disruption and innovation and opportunities for entrepreneurs that have new ways of approaching these challenges and new technologies that can serve this role. The nature of the Leading Edge seminar series is that we wanted to create a space to allow an understanding of the kind of the space around some of the key issues. We've done energy efficiency. We're going to have one next month on smart grids. So really understanding what is the nature of the issue and the state of the market around some of these areas. Second of all, to hear from practitioners that are really involved in the day-to-day activity in terms of moving this forward, whether they're in a business that sells energy efficient equipment, what are the challenges and the opportunities there? In this case, energy entrepreneurs and the kind of opportunities they see and that they're developing, what are the challenges and the opportunities, to hear really what it's like to be trying to move forward an entrepreneurial venture in a meaningful way. And then finally, to get you guys out of sort of the passive listening mode and engaged actively in thinking about, well, what are these challenges and what could I bring in terms of addressing some of the real barriers and challenges around that. That's roughly the structure of all of the Leading Edge seminars. We have an opening presentation today by Steve Taub, who's from GE Energy Financial Services. We're really pleased that he's able to join us today. He's got a long history in the energy space, and in this case on the financial side, and in a company that has a really broad purview, I think, globally and across the industry about the nature of the kind of funding environment, the innovation sort of portfolio that's emerging, and what the playing field really looks like. So Steve is here for the opening presentation. I'll introduce the panelists briefly when we move into the panel discussion in the second hour, and then we're pleased that we have one of the student venture teams with us, Hightower, that are going to be sort of the target venture for us to think through what is their proposal, how are they approaching the opportunity, and then what are some of the key challenges, and get all of you involved in brainstorming with them about how to solve those challenges. So let me give you a little bit more background on Steve, and then I'll turn it over to him for an opening presentation to kind of create the landscape around this issue. As I said, Steve is from the GE Energy Financial Services. He described his job as being sort of on two sides. One is in the area of kind of understanding the market and policy environment around large-scale corporate financing of energy projects, not only in the renewable space, but really across the entire energy portfolio. So that's one side of his job. The other side is more focused on GE's venture investments in the energy area. And that's really the basis of what he'll be talking about today. But I wanted to let you know he's not only in the venture side of this, he's also very much involved in the larger scale corporate finance. That's actually an area we've heard from several of you that you'd like to know more about. And I'd like to, in the reception and elsewhere, work with Steve and some of the other panelists to sort of flesh out what might that look like for us to offer more content in that area. Steve came to GE from Cambridge Energy Research Associates, the organization that Dan Yergin leads, and is a real, I think, leading authority in this space. So amongst some of the best academic and really rigorous thinkers about the future of the energy business. Prior to that, he was with the U.S. Department of Energy in the Office of Environmental Management, and had some interesting stories over lunch about the scale of efforts that happened through DOE, given the long legacy of research in the military applications and the environmental legacy that was associated with that, how the government's currently trying to deal with that. So a really interesting set of experiences that he brings to this. He has a master's degree in mechanical engineering and technology and policy from MIT, one of the leading schools in this area, and completed an engineering program from Virginia Polytechnic Institute and State University, and work in corporate finance at Harvard. So a really great kind of background, and I think has a view on the industry that all of you will find really enlightening and sort of giving you a broader sense of the current state of play around energy entrepreneurship and where some of the opportunities might be. With that, I'll turn it over to Steve. Thanks for being here, Steve.
Great. Thanks for the introduction, Dan. Put the mic on. How's that? All right. Is it on now? Yeah. Usually I don't need a mic in a room like this, but I guess for the camera, it will be helpful. So, what I'd like to do is, there we go. Just first, I'll tell you a little bit more about sort of who I am and what I do for GE, and a little bit more about the General Electric company and kind of what we do in energy. And then I'm going to focus, as Dan said, mostly on the venture capital investments that GE is making in the energy sector, and a little bit about what we and what other venture capitalists are looking for as when we're evaluating opportunities, and some of the interesting things that go on there. So, as Dan said, GE Energy Financial Services, that's the name of the business I work for. It is part of GE Capital. So I'm sure everybody in the room knows GE, right? You probably all have 10 GE products in your house somewhere. So one of the GE's major businesses is financial services. GE Capital is one of the largest financial institutions in the country. It's roughly a $400 billion balance sheet. So give you a sense, that's about twice Wells Fargo. Not big in consumer banking, but in things like aircraft leasing and commercial real estate and private label credit cards and equipment leasing, middle market corporate finance, things like that. One of the big areas that the GE is investing in is energy. Energy investments are about 10% of GE Capital's balance sheet. And it's a pretty diversified set of investments. Mostly it's big assets, power plants, oil and gas reserves, pipelines, things like that. One of the fastest growing and now largest parts of that portfolio now is renewables. So we recently actually announced at the end of last year that we had met a target that we'd established to have $6 billion of GE's money invested in renewable energy assets by the end of last year. And we were very happy that we were able to make that target. And the renewables assets, much of that, about 5 of the 6 billion, is investments in wind farms here in the United States. But we have, the remaining billion is spread across solar, hydro, biomass, landfill gas, lots of other things. It also includes our venture capital portfolio. And as you see here, not only are we investing across the energy spectrum, but we're also investing across the capital spectrum. So everything from senior secured debt in project finance transactions to asset-based loans and revolvers on the corporate finance side to equity in early stage technology companies to leases and structured partnerships on big energy projects. So lots of different kinds of investments that the company is making. And as you can see here, we have roughly 300 different investments on our books. GE's been investing in energy now for 25, 30 years and has really built up a lot of expertise and a lot of good history there. And just to give a sense, this is actually one of the most profitable parts of GE Capital. We generate about 10% of GE Capital's net income with 5% of the assets. So, kind of turning now to, kind of energy entrepreneurship, I think this kind of says it all right. Entrepreneurs have discovered energy, right? I'm sure this is not news to any of you. But, there's a huge number of new ventures. And I mean, I can tell you, I've been working with new technologies and startup companies in energy now for over 10 years. And I can remember sort of the first big wave of excitement in the early 90s, or sorry, in the late 90s. Early 2000s, which disappointed a lot of people. And what we see now is just completely orders of magnitude more. We're seeing not only more entrepreneurs, but better technologies, better business plans, and bigger and better markets as well. And got cut off a little bit there. What that says is large industry, many subsectors, right? So people focus a lot on clean tech. Which is a big part of where we see entrepreneurs and innovators in energy these days. Solar power, energy efficiency, water technology, things like that. But there is also an enormous amount of activity going on in what you consider traditional energy too. Things like emissions controls, things like oil and gas technologies, and water, which is often closely aligned with the energy sector as well, because water is a very energy intensive and asset intensive business too. Just to give you a sense of scale here, so we've been making, we made our first venture capital investment in energy in our current team in 2006. Since then we've seen probably 5,000 business plans and just an enormous range of ideas and technologies. So there's tremendous activity here, and now we're starting to see serial entrepreneurs, guys who and women who they had their first venture, and sometimes that was a huge success, and then they're on to the next one. Sometimes it was a dismal failure, and now they're on to the next one. But we're starting to see now repeat offenders in the entrepreneurial space as well, which is actually very encouraging. And as you can see here, not only have entrepreneurs discovered energy, but so have investors. This is just venture capital investments in clean tech. So that's not all of the money that's going into energy venture capital, although the majority of it, probably 75 or 80%. But you can see, if it's hard to read the numbers back there, you're talking on the order of $6 to $8 billion a year of venture capital investment happening in energy these days, and in something like 700 transactions last year. So tremendous activity going on. Energy and clean tech is now the single largest sector of venture capital investments when you measure it by the dollars. It's overtaken healthcare, it's overtaken software, it's overtaken telecommunications and everything else. And 70% of those investments, by the way, are happening in the United States. So the U.S. is still really a hub of activity, particularly the California and the Boston area, but we see companies all over the country, including some in this area. Other big centers that we see are in Europe, particularly around Munich, and in the UK. A lot of technology there. Some up in Canada, and also Israel is a real kind of hotbed of energy entrepreneurs and innovations. And of course, we see companies in Australia and Taiwan and lots of other places too. It's really a global trend. So, what are we looking for as investors? Well, first of all, we're looking for a lot of the same things that other venture capitalists are looking for, right? So what do venture capitalists want when they're looking at investment? Well, first we're looking at the market, right? What's the market for this this technology or this service or this innovation? How big is it? How quickly is it growing? What's the structure of that market? Generally speaking, you know, we're looking for things that can become big companies in the future. And in order to become a big company, you need a big market. That's pretty obvious, I think. In some cases, you see things that are big markets today that are ripe for innovation, and in other cases, you see things that are just starting now that could have the potential to become very big markets in the future. But that's kind of the first thing we're looking for. You know, next thing you're looking for is the technology, right, or the innovation. Technology doesn't have to be a physical thing, right? It can be a business model. You know, how much value does this technology create for the user, for the customer? How much value does it create for the supplier, for the entrepreneurs themselves? You know, I was in a meeting yesterday actually with some folks, and you know, they were talking about materials innovation. You know, how innovations in materials manufacturing and processing have really created, you know, huge revolutions. And the two examples they used were the Bessemer steel furnace, which reduced the cost of steel by roughly 80% and increased the quality too, and the Pilkington float glass process, which reduced the cost of plate glass by about 80% and allowed glass to become a major building material, for example. And the interesting thing of that, of course, is that Pilkington went into the glass business and became a billionaire. Bessemer was selling furnaces, and Andrew Carnegie made all the money. So it's important to understand, not only is the technology really valuable, but who's going to capture that value is very important. And of course, the other thing is, is it defensible? Can you protect this technology? How easily can it be replicated? Can you protect it with patents? Are there barriers to other barriers to entry that will prevent other people from coming in and following you and capturing a lot of that benefit once you've shown them the way and created the market? So that's a hugely important factor. The third thing is the team, the management, because ultimately, another good saying that I heard recently from one of our company executives, right, is, before you invest in the horse, you want to make sure you like the jockey. The management are the people who are really going to make this happen. The investors can only do so much. You need to trust the management's judgment. You need to want to make sure that the management is going to have the expertise to, attack all the key problems that need to be gotten through. You also want to make sure that the management is going to get along well with each other and with their investors. The personalities are important too here. But the management team is a critical factor for all venture capitalists. Another important factor here is the stage. So this may not be obvious to folks who haven't worked in venture capital, but there are lots of different flavors of venture capitalists. There are some folks who invest in very early stage companies, really just ideas out of a laboratory or two guys in a garage. What we call angel investors or seed round investors. So that's kind of one extreme, right? People who are investing really early, taking a lot of risk, but also hopefully getting the best rewards for taking that risk. At the other end of the spectrum, you may see institutional investors, hedge funds, investment banks, big corporations in some cases that are investing in fairly mature companies that are still just on the beginnings of rapid growth, maybe. So that kind of growth investing is a totally different game from the seed or the angel round. And then of course there are lots of folks in the middle as well. So you see a lot of venture capitalists who they might see a technology, for example, or a company that they think is really interesting, but it's just too early stage for them. They may have a fund that is that's got a 7-year investment period, and they're in year 5, and they can't wait 7 or 8 years for this company to mature and become really successful. Or conversely, they may not be in a position to invest in something really late stage because it requires you to write a much bigger check, and they don't have a big fund because they focus on making small investments in early stage companies. So the stage is very important. And just to give you a sense, GE, we're usually kind of a middle stage investor. We usually like to invest in companies that are maybe in their second round of financing or so forth. That's usually what we're focused on. The co-investors are another important factor, right? Because they are in many cases your partners in helping to make a company a success. So it's important to know that you're going to get along with them, and that your interests are aligned economically. Sometimes you see problems where you have two investors, and one investor has a much lower share price than the other because they invested earlier, and therefore they might have very different financial motivations. You may have one investor who's a strategic, who has other motivations than besides just making the company a financial success on its own. So another issue that sometimes you run into is you'll see a company, and the other investors around the table are all tapped out. Either they've invested their fund and they don't have any money left, and dry powder is what people in the industry call it, or they've kind of reached their limits on how much they can have invested in one particular company, and so they might be great strategic advisors to the company, adding lots of value, but the company needs more money. They have a problem. You've got to find new investors to come in, which can be difficult sometimes. Knowing your co-investors is very important as well. Capital intensity is a big factor that a lot of venture capitalists care about. How much money is going to need to go into this company, right? And obviously part of that is because the more money that goes in, the more money has to come out at the other end of the process, right? So it's very important from that perspective. It's important because you have to know, well, if I invest now in the B round, how much money do I have to set aside for the C round and maybe the D round later on? I'm probably not the only investor. So, as I said before, who else around the table at the board meetings is going to have the money to put in, and how comfortable are we that this company's going to be able to find new investors who are going to bring in lots of additional capital? And there's a very wide range of, we've seen some companies that have been able to get to cash flow positive with a few $1 million. And there's other companies out there that have raised $1 billion and are still not cash flow positive. This is a very important factor. And then, of course, risk and return. Look, ultimately, venture capitalists are buying stock in companies, right? And we want to buy that stock at a price that gives us enough upside to make it worth taking the risk. The way venture capital works is it's kind of a funnel. So we see, as I said before, roughly 1,000 opportunities or 1,000 business plans a year. Out of those 1,000, we'll probably do more than a cursory glance at 100. We might do more in-depth due diligence on maybe 20. We'll make 10 investments out of that 1,000. So there's a huge funnel going into this. And once you're into those companies, you're basically these are private companies, right? So you need to make sure that you're getting compensated for the risks you're taking with your money. Out of those 10 investments that you made in a particular year, 2 or 3 of those companies are going to go bankrupt. You're going to get nothing. Your money, poof, gone. A couple more of those companies, they'll struggle, and they'll kind of, they'll peter out, and they might sell some assets, and you might get 50 cents back on your dollar. A couple more of those companies, they'll do all right. They'll find a buyer, or something like that, and maybe you'll break even, or you'll get a 10 or 20% return on your investment. And hopefully, out of those 10, maybe, hopefully 2 of them, you'll get 10 times your money back. And that, of course, pays for everything, right? And if you're Kleiner Perkins or somebody like that who's got a really good track record, it's not 2, it's 3. Or you've got a Google where you get 1,000 times your money back instead of 10. That's the economics of the venture capital business. And the returns are very asymmetrical. But it's important to know that what kind of risk are you taking for that return? Because you need to know that some of those companies you're investing in are going to be able to provide you with the if they go well, with the return that makes the whole process worthwhile. And just to give you a sense, on a portfolio basis, a reasonably good venture capital fund on a portfolio basis will return about twice the dollars that went into it. A really good one, top tier might return 2.5 or 3 times on a cash-on-cash basis. A lot of venture capital funds break even or lose money. There's a lot of nonprofit venture capitalists out there, they just don't know it. And of course, you don't know it until the end, right? I mean, there's another, I hate to use all these old sayings, another one, lemons ripen early. The failures become evident a lot more quickly than the successes. And so, at the beginning of a fund and even in the middle, you're making investments in new companies, you're making follow-on investments in the ones you've got, and some of the ones that you made, you're writing off. And so there's what people call the J curve, right? Your returns start off at zero, they go negative for a while, and hopefully they turn positive at some point. So those are the kinds of things that venture capitalists are looking for when they're talking to entrepreneurs. And as a result, these are the kinds of things that entrepreneurs generally are looking at when they're thinking about new business ventures. Then, I work for the General Electric company, right? So we have some other considerations that a lot of venture capitalists, Vinod Khosla doesn't care about these things as much as we do, but they're important. They're important to us, So we're looking for not only what makes a good investment, but we're looking for what benefits can we find for the General Electric company. So, for example, we've made investments in companies that are suppliers to GE, which benefits the company because they have a supplier that's got funding so they can deliver on their contracts. Channel partners, another example, companies that GE is actually co-selling with. In some cases we're looking for companies that have technology that GE can use. GE can actually be a customer. We've got a couple of examples of that too. Where they may take something these guys are developing and they may say, well, we can use that to manufacture this and we can build it into that product and create whole new things that benefits the company and also benefits the portfolio company and also benefits the General Electric company. And of course, large new markets adjacent to GE. So a good example of this might be electric vehicles, which GE is not in the vehicle business. They probably will never want to be an auto manufacturer or a tier 1 supplier. But as you can imagine, they have lots of adjacencies to electric vehicles, from manufacturing and supplying the charging infrastructure to the power plants that will feed the charging infrastructure, to the fleet leasing business in GE Capital, to the fact, not only does our business have several $1 billion invested in oil and gas reserves and several more billion in pipelines and drill ships and so forth, but GE is actually one of the largest oil field technology companies in the world. So they have lots of considerations, and they burn lots of stuff that they make lots of stuff that can be electrified, not vehicles, but locomotives, for example, heavy duty vehicle drivetrains. So corporate venture capital is a little bit different from their sort of standard institutional firms, but really we're all ultimately looking at the same things as investments. A lot of these values on the right side of the page, these are great things for the company, but they're hard to quantify up front, particularly with an early stage venture. And what that means in practice is I don't get any credit for it when I have to bring something to the investment committee. The investment has to stand on its own. Oops.
Maybe above. No,
there we go. So, the markets and the economics are real, right? And I said, first thing we're looking for is, we're looking at the market. How big is it? How mature is it? How quickly is it growing? And we're looking at the technology and what's the value creation. And clearly in energy, I think there's no doubt that this is real. So, again, this is a little bit busy here. I apologize. But on the left side of the screen, you see the growth in, at the top there, that's installations of photovoltaics. That's in gigawatts per year. So how big is a gigawatt? A nuclear power plant is a gigawatt. So last year, 16 gigawatts of photovoltaics were installed. And that was more than twice what was installed the year before. Enormous growth, right? So 2010, this was a $25 billion market. That actually doesn't seem right. It should be bigger than that. I think it was more like an $80 billion market. $25 billion, I think, is probably just for the panels, not the whole projects. And growing at 50% growth rate on average for well over a decade now. Wind, same thing. The wind industry now, 35, 40 gigawatts a year of wind is installed. Roughly half of the, or 40% to 50% of the megawatts installed in the United States and in Western Europe in the last few years have been wind farms. So this is real. This is, again, $70 billion market last year, growing at over 20% a year on average. Right? These are big numbers that get people's attention as investors. And as I said, the economics are real. So on the right here, this is some examples from energy efficiency, right? Which, we see lots of companies who are developing energy efficiency technologies or trying to deploy that. And so a little bit of a complicated chart, but especially since you can't read the axes with the formatting glitch. But basically what this is showing is the cost of power for the purple is residential and the dark blue is commercial and industrial. I think commercial, actually. And, in quintiles. And I mean, what you see is the economic range for energy efficiency. So, the cost per kilowatt hour saved, excuse me, is, in the range of 3, 5, maybe 6 cents a kilowatt hour. And that is pretty much lower than all but the lowest quintile of electricity prices in the U.S. And the U.S. has relatively low electricity prices compared to the rest of the world. And in fact, this is the same chart for Europe, except instead of in quintiles, it's by country. And you can see that that range is lower than the cheapest electricity that you see in major European countries. So the economics of this stuff are real, and that of course that drives adoption. Right? That helps create the markets. It helps. That's the pie that gets split up between the entrepreneurs and the consumers and the investors ultimately. Here's another example of how this is real. I used the examples of electric vehicles before. This is some historical data. Each one of these dots is this is a chart of cars per 1,000 people on the vertical axis and GDP per capita on the horizontal axis. And what you see is once you get to about $10,000 per capita of GDP, you just have this enormous takeoff in the adoption of cars, right? Personal mobility. People can afford it, they want it, and that happens. And if you look down here and you see, well, here's Brazil, there's China. India is a little bit further back over here, but huge countries approaching that threshold that countries like the United States and Canada and Germany and Japan reached a long time ago. And there's India and China. That's 2 billion people right there, potentially buying cars. And so you do the quick math and you say, well, if they get to 500 cars per 1,000 people, how many cars is that? That's an awful lot of cars. And somebody's and will those cars be those cars are going to be consuming fuel? They may be consuming electricity. They may be conventional kind of cars that we drive here in the U.S. They may be different. They might be electric cars. They might be a new form of personal mobility that is more tailored to their needs than versus what we have here. Again, it's a large and rapidly growing market, and that creates opportunity for entrepreneurs. Why does GE care about this? I mean, GE touches energy from pretty much all sides, from the production, from the consumption, and all of the things that happen in between. It's an industry leader in renewables and smart grid, in oil and gas, and lots of other spaces. They've also been a champion and an advocate for the industry in policy circles and in the public. And just some examples here. A lot of you have probably seen the Eco-Imagination commercials on TV, right? As an example. And energy financial services. Our business is a relatively small business actually within GE, but makes a big difference. We are a leading energy investor. Lots of expertise. So all of this innovation and entrepreneurship around energy matters a lot to the company. We like to think that we're making an impact here. Of course, we also have a large global research organization that we leverage as investors. So a lot of our due diligence on the technology side, we really reach into this organization, and it's a global organization. You can see here, centers in Germany, China, India, as well as in upstate New York. I've lost it again.
Can we just use the arrow on the keyboard?
Yeah. I keep pointing to different things and it's not cooperating. All right. So I wanted to talk a little bit about why are we making venture capital investments, right? I mean, from a macro perspective, venture capital has had a huge impact economically with a relatively small number of dollars. And if you look up at the chart here, so this is showing the the money that's been invested in R&D by, industry is the gray, government is the sort of dark crimson there, universities are the next bright red, and then that little tiny blue sliver on the top is venture capital, right? But the impact has been enormous. I think, look at the S&P 500 and see how many companies in that list are, or the Fortune 500, see how many companies at the top of that list were backed by venture capitalists. Apple, Google, Microsoft, pharmaceutical companies. It's had a disproportionate impact. So, venture capital is essentially, it's been a really efficient way to find and commercialize new technologies and new business models that have a big impact. So a company as big and diverse as General Electric, particularly in energy, we can't ignore that, right? So obviously we're looking for attractive financial returns. As I said, I don't get any credit for any strategic benefits that the company gets out of investments. But it's more than that, right? It's the window on technology, seeing the next billion-dollar markets and the next billion-dollar companies and technology platforms. It's the opportunity to collaborate with the companies, right? Which for entrepreneurs, is a huge benefit in many cases, in terms of credibility and in terms of resources and expertise. And then, of course, there's the expertise building and the network effect that comes out of it. So, we're investing to make money, but we're also investing for strategic reasons. And I think a lot of, you see more and more corporations who are getting into venture capital, particularly around energy, oil companies, utilities, other technology companies, for a lot of the same reasons. That's how it worked. And I won't dwell on this because I think I've already said it. We're trying to offer, we offer the portfolio companies more than just money with our investments. So it's the access to, to the markets, it's the access to the expertise, it's the, the credibility and so forth. So this is just to give you a sense of our venture capital portfolio. There's a couple of, there's a few things that are left off here. So we've got about, I think, 28 portfolio companies now, including several that are not disclosed here. And just to give you a sense of some of the areas where we're seeing some particularly interesting innovations in energy. Renewable power, as I said, that's been a very active sector, probably the most active sector of energy venture capital for the last few years. And we've made a number of investments in companies. So these two over here, wind gearboxes, composite wind blades, those are examples of companies that are actually, they're suppliers to GE. GE buys wind turbine blades from TPI Composites that are made in an old Maytag appliance factory in Iowa. They also manufacture blades in China. And they're not, they supply other companies too, I should say. This one here is the gearbox manufacturer. It's called China High Speed Gear, is a gearbox supplier. We've got investments in small wind too. Southwest Wind Power is a company based in Arizona that is the largest, kind of the leading manufacturer of small kilowatt scale wind turbines for commercial and residential applications. So I don't know if anybody, for instance, is a sailor, but they're turbines you often see on sailboats as a source of electricity for radios and lights and things. And they've got new technology out now for turbines that can be put at homes and businesses that is very attractive economically. We're seeing, based on our analysis, wind turbines that can make power for homes at less than 10 cents a kilowatt hour, which potentially is a game changer for small wind. On the solar side, a couple of examples. Alta Devices here. This is a company that makes thin film solar cells, very efficient, very low cost solar cells. It's an earlier stage company, which is why it's kind of on this side of the page, but a company that has just a phenomenal cost entitlement with their technology that could be a game changer, sort of like First Solar has been. We think this is one of the very few companies that we've seen out of hundreds of solar companies that actually has a good chance of beating First Solar, if you're familiar with them, in terms of their cost and performance. Another example here is a company called SolarEdge that makes microinverters. So this is a way basically that you can optimize the power production of a solar installation panel by panel, which can actually get you 10% or so more energy out of the installation than you get by doing it the traditional way, and with a relatively small incremental cost. So those are just some examples of some of the companies that we've invested in there. A lot here on energy efficiency and smart grid and vehicle electrification, things like that. People might be familiar with 1366. Sorry, that's something else. A123 Systems, which is a manufacturer of lithium-ion batteries. Initially, their first market for commercialization was power tools. Where they had a pretty good value proposition. They actually had a battery that could deliver more power to the cordless drill than the wall socket, believe it or not. But really, the big market opportunity for these guys is electric vehicles, they've been one of the leaders there. That's a company that actually has gone public, by the way. Trillient is a company that makes smart grid technology for reading electric meters in a very network fashion. It's called a mesh network, where the meter, instead of all the meters communicating back to one central point, the meters actually can communicate in a sort of a chain to get the information back to the central office, and makes a much more robust network. So lots of different things. Synapse Sense is a company that's got technology for optimizing the energy consumption of data centers. Computer data centers use a material fraction of the electricity in this country now is consumed by computer data centers. And I don't, off the top of my head, know what that number is. It's maybe 1 or 2% of our electricity, something like that. And very, very energy intensive, right? And electricity is their biggest operating cost. And so this is a company that's got sensing and analysis and control technology to help reduce that. Creates a lot of value. Another interesting one here, Solidyne is a company that's making electrochromic windows. So these are basically windows where you can control the tint with a small electrical current, which allows you to optimize the sunlight and the heat gain of the building to reduce energy consumption. Also gives architects some nice flexibility when they're designing things. On the oil and gas and fuel side, again, lots of different things. So Cirrus Energy is an interesting one. This is a company that has figured out how to feed the microbes that already exist in coal seams. So if you actually go down to a coal seam, there are microbes down there that are slowly digesting the coal and making methane, which is natural gas. You can actually produce that natural gas today, but what these guys have figured out how to do is how to basically feed those bugs to accelerate the process by orders of magnitude, so that you can take a coal seam, and this works best, by the way, on the lowest value coal out there. You can take that low value coal seam and you can turn it into a very large and productive and low cost natural gas well or natural gas field. It's an enormous market for that, right? Huge appetite for natural gas, and lots of resources there. Another interesting company here, Cool Planet Biofuels, has figured out a way to make gasoline, not ethanol or some biobutanol or something, but real gasoline out of biomass at a way that we think is going to be competitive at a pretty low price per barrel of oil. As you can imagine, we've probably looked at every single advanced biofuels company out there, and this is the first one that we saw that we thought could actually produce the right product at a cost that was going to be competitive in the long run. And so we've made an investment here. I wanted to mention a couple things that you probably don't see here, which you might be surprised by. So, there's been a lot of companies who have been developing, large-scale solar technology, solar thermal power technology, for example. There's a lot of companies that have been developing advanced biofuels, either cellulosic ethanol or even advanced, biogasoline, things like that, with gasification technology. There's companies who are developing enhanced geothermal, where you can take the energy out of hot, dry rocks underground and turn that into electricity. Lots of other things like that too. They're fairly capital-intensive technologies. Remember, I said earlier, we care a lot about the capital intensity of these things, and as you might notice from this portfolio slide, we've shied away from those because of the challenges of raising that capital, and because of the challenges of even once you've developed the technology, there's an additional valley of death, as people call it, to get them commercialized. To get big companies to build them, and to get big financial institutions to finance them. Since we're in that business too, hopefully we tended to shy away from those because we understood the difficulties. But some of those may actually turn out to be successful in the long run. But that was a case where we even think the risk-reward profile made sense. That's my last. No, not quite. One other thing I want to mention is the Eco-Imagination Challenge. This is an example where we're really kind of opening the doors and asking entrepreneurs to come to GE with their best ideas. So this was actually launched back in summer of last year, and we announced the first round of winners, if you will, back in November, about a dozen companies. And this is an example of crowdsourcing, I guess you'd say, or open innovation, where we had over 3,800, I think it's actually over 4,000 submissions from entrepreneurs all around the world, 150 different countries. We had people could vote on what are the best ideas, and we had over 130,000 votes. Over 80,000 comments from people. So just a lot of engagement. Just gives you a sense of how many entrepreneurs are out there, how many people care about this. I can't imagine you would have gotten this level of participation 10 years ago in something like this. But this is something that's actually become a permanent platform now. So GE has actually announced phase 2 of this Eco-Imagination Challenge called Powering Your Home back in January, about a month ago. So if you're interested, actually, take a look at that, and if you have an idea or you want to submit, I encourage you to do that. Aside from just the prestige of winning, there are actually cash grants and the possibility of getting an investment from GE or one of our venture capital partners as part of that challenge. So I guess the last thing I want to talk about is kind of what's happening in the future. What's in the crystal ball. And it's kind of a balanced story. There are some great reasons to be optimistic about the future of energy entrepreneurship, but there are also some real reasons for caution. On the optimism side, there are very strong long-term signals for technology adoption, right? Everything from the high price of oil, the efforts to control carbon emissions and put a price on carbon, the rapid industrialization of countries like China and India and Brazil. And the reindustrialization of countries like Russia, for that matter, driving energy demand. So there's lots of signals for the need for more energy and cleaner energy and better energy and smarter energy. That's translated into government support. In the United States, in Europe, in China, in Australia, governments are really focused on this now in a way that they have not been in the past. And I think you're seeing much more of a long-term commitment to these kinds of issues. As an investor, we're seeing a little bit of the hype has deflated. So as an investor, we're seeing more realistic valuations for companies that we're looking at investing in. And that, in the long run is a good thing. Everybody gets excited when, a company raises money at $1 billion valuation, but, if it's overpriced, that's really not good for anybody in the long run. We are seeing some of the companies, at least some of the earlier companies, maturing. They're retiring risk, they're increasing their sales, they're growing their markets, again, that tends to be self-reinforcing. The IPO market is returning. It's not the dot-com boom, but there are investors looking to buy stocks, while there are certainly lots of ways you can invest in solar now as a stock buyer, it's still pretty tough if you want to make an investment in electric vehicles, for example. There's not a lot of choices out there. So there is a hunger for some of these things. And there has been a shakeout. I mean, the strongest are surviving. And that, again, that's good for the long-term health of the whole industry. But there are some reasons for caution, right? I don't want to paint an overly rosy picture. The economics of some of these new technologies are being challenged. With the slowdown in the economy, natural gas prices are down, energy demand is down. There's budget pressure that's causing countries to ratchet back subsidies and support mechanisms. And that is slowing down adoption. Here in the United States, just as an example, this is a major reason why the wind industry installed 10 gigawatts last year, 10 gigawatts in 2009 and 5 gigawatts last year. It was because of this kind of issue. The reduced demand makes energy markets even more brutally competitive than they normally are, and they're normally pretty darn competitive. It is more difficult these days to raise capital, so entrepreneurs are having to take more time and work harder to get the money they need to fund their ideas. And at the same time, on the other end of the process, customers have less money to spend, and they're more cautious about spending it. While we do see a broad trend of supportive policy, it's hard to predict. You see on and off support in some places. You see uncertainty about whether things will continue. Even if you think it's going to continue, you don't know for how long or whether at the same level. And that does make it difficult for people to plan. We're not seeing a huge amount of M&A in the clean tech and energy space. So the two ways that startups exit, as we say, most of them they'll either go public, or more commonly they'll be acquired by a bigger company. And we're not really seeing that yet. I mean, there's some activity, but it's not like people had hoped it would be. You have not seen the good example is Cisco, for example, that was just acquiring 50 companies a year, 100 companies a year 10 years ago in the telecom sector. There's nothing like that in energy. And certainly when you do see acquisitions, the valuations are being paid are generally not the sort of thing that get a lot of entrepreneurs excited. Finally, on the public side, while there is a lot of interest in investments here, there are other sectors that are giving pretty attractive returns these days. And so that does make it harder for companies, in the public markets too. So, overall, I mean, we think there's a bright future here. The world needs these technologies. The world is certainly going to need not only more, but cleaner and smarter energy. These energy technologies are going to need a lot of capital to scale, and so that means lots of opportunity for investors and lots of opportunity for entrepreneurs too. But it's not going to be an overnight shift. It's going to take a long time. This is a very large, very capital-intensive, long-lived asset industry, and the process is going to be gradual. So that's all I got.
Great.
I'm happy to take questions.
Time for a couple of questions for Steve, and Hugh also will be on the panel when we go to that phase. So hopefully have a chance to surface a lot of the issues that came up in the panel discussion. But I'll open it up to questions now.
Do portfolio companies ever worry about coming to you and basically sharing their ideas with such a team if they could probably scale these things up much faster than they could?
It's funny. That does happen sometimes. I mean, there are companies that say, well, we don't really want to, sort of show you our secret sauce, because they are afraid that, of some of those things. But by and large, it's not really an issue. Most people really see having an investor like GE as a benefit and want to get us in. From a practical standpoint, first of all, we're GE Capital, right? And so, we're not the industrial side of the company. We have firewalls. Some of our investments are in companies that are GE suppliers, right? We have to maintain confidentiality. GE can't see what their costs are and their profit margins, right? They can't see what they're doing with competitors to GE, and we have to be careful about that sort of thing. We have to be careful. We sign NDAs. In many cases, when if it's something that's particularly sensitive or particularly close to an area that GE is in. But yeah, I mean, there are folks who say, well, if I dance with an elephant, I'm going to get stepped on. But honestly, it doesn't happen very often, in my experience.
So how do the profits on these clean tech VC investments compare to other areas?
I would say it's too early to tell. Really, people started making a lot of investments in this sector maybe 5 years ago. So if you look at that J curve, it usually starts to turn positive after around 5 years. So on a portfolio basis, it's too soon to tell. I mean, there certainly have been some successes, and there have certainly been some real failures too, including some companies that have raised a lot of money. But I think the jury is still out on that. Other questions? Yep.
Getting into this, was energy ever an interest of yours, or did you just kind of fall into this?
You know, it's funny. I think Dan said, I went to engineering school. I actually wanted to build airplanes. And when I graduated from college, there wasn't a lot of opportunity in doing that. Right after the end of the Cold War and all that. So I kind of got into energy somewhat by accident, but I was a mechanical engineer, and I said, well, I learned how power plants work in thermodynamics class, and that was kind of how I got into energy, honestly. It kills me to think of all the math and science that I learned and never used, but it's useful. It's useful to understand, even if I couldn't do the engineering work myself, it's useful to understand how things work and understand how the technologies function, or what the weaknesses are likely to be and the strengths, and how the processes, the design and manufacturing process and so forth goes. So.
Question. Do you see the massive capex that the utility industry is going to be doing over the next decade, sort of sucking the air out of the room for more innovative sorts of things?
Generally, no. What we see is utilities have generally no trouble raising capital right now. They're investment grade credits. The bond markets like them. There's not enough supply of utility bonds out there, and they're able to issue equity with pretty attractive cost of capital too. Most of their investment is going into things that venture capitalists and entrepreneurs don't really do. It's transmission lines and distribution lines, and it's actually, and if anything, that money is fueling the adoption of technologies, right? So, if Duke Energy here wants to put in a smart grid system, they can go to the capital market and get the $1 billion they need, and then they can go to Trilliant, our portfolio company, or somebody else, and buy the technology that they need to do that with that money. So I think, if anything, it's helpful.
It's helpful. Okay.
Yeah, I don't think it's competition. You had a question?
Yes, in fact, you were just leading into it, because I was going to ask about transmission and distribution as being one of the biggest limiting factors to the growth of renewables, and I was wondering what kind of interest level GE has in investing in that in the future.
Yeah, on the industrial side, GE does, they supply switchgear and transformers and things like that, some of the equipment. As project investors, there are some transmission projects that are developed by non-utility companies that we have an opportunity to invest in or lend to, and that can be interesting. Although it's a relatively small number. There's maybe one project a year versus there's 20 or 30 wind projects a year that we could invest in. As a venture investor, there is some technology. On the distribution side, particularly, you see a lot of technology around smart grid. Everything from meters to switches to sensors to controls and all sorts of things. So there's a lot of innovation on ways to add sensing and intelligence and data analysis and automation to the distribution network in particular. And there's also there's some of these technologies that could potentially help take some of the pressure off by reducing demand, or at least giving more control over demand, or by having more distributed resources with solar on rooftops and things like that. But you don't see a lot of it's interesting. Project development has got a lot of similarities to technology entrepreneurs. People who develop projects, they go out and they have an idea, and they scrape together some money and they max out their credit cards and they find a site and they get the permits and they negotiate the contracts and all these sorts of things. And for every 10 projects you start with, you'll finish one if you're lucky, but that one will pay for everything and more. So in many ways, it's actually very similar, but it's a completely different set of investors for the most part. You don't see technology venture capitalists are not investing in project developers by and large, because it's a very different game, even though the economics are similar. And there are folks who do that. Particularly they like to back they like to back developers who have a track record. Guys who, and ladies and gentlemen, who have done this before. So it's kind of hard. If you're a first timer, it is pretty tough to get the funding to develop, let alone build your first project. But if you've done this a couple of times, you got a track record. If you've done this for a company like, a big company like Duke or AES or NRG Energy or something like that, there are investors who do that, and it's got some similarities. And that can apply to transmission. I kind of went a little bit afield from your question, but you see some of that in transmission too. Folks who are developers of transmission, and that kind of development has similar features to technology venture capital.
Great. Well, thanks very much, Steve. take a really quick 5-minute break, bio break. We'll get the panel set up, and John Field, who runs the Center for Entrepreneurship and Innovation, is here. He'll be leading the panel discussion with the other entrepreneurs. So be back and see you in 5 minutes. Okay, thanks.
Produced by Duke University. Online at duke.edu.